Well, the current tax bill is sailing through Congress. It's gone through House Ways and Means Committee. They call it a markup. It is now going to the full House. And I want to break down in today's video how this affects individual taxpayers. I'm not talking about weird provisions you might qualify for. I'm talking everyday Americans making $100K, $200K a year, how this saves you taxes. Now, I'm going to go through two examples in today's live where I'm going to outline how the rate reduction, the increase of the standard deduction, and the child tax credit is going to put thousands, if not tens of thousands of dollars back in your pocket and not going to the government. Now, there's a lot of stuff going on in the bill, and just a quick highlight of where things are at in the political process is this is going to the full House. After it goes through the full House, it is going to go to the Senate, assuming it passes. And then once it goes through the Senate and passes, it goes to the president's desk. Now, the goal of the Republican Party is to have this on Trump's desk by July 4th to be enacted into law. Now, some of the provisions here go into effect in 2025. That's important. I'm going to note those as we go through the video. Some of them don't go into effect until 2026. So some of the stuff matters on your return right now. Some of this stuff is more important in 2026. Now, the big issue that's looming over us right now as taxpayers is the last tax reform that passed 9 years ago is set to expire this year. And what happened in the last tax reform is they lowered the rates 2 to 3% for every bracket. They doubled the standard deduction. They give us a lot of great tax incentives. Small business got a 20% deduction. They got bonus depreciation. Well, all of that stuff is going away this year, which means taxes are going up next year if a bill doesn't pass. So there's a lot of pressure mounting on Congress, and definitely the conservatives that want to lower taxes and the moderates that in both houses, I should say in both political parties, Democrats and Republicans, want to see a lot of this tax reform enacted. Now, make no mistake, everyone wins in this bill. High income, middle income, low income, everyone wins in this bill. And I'm going to show you as we go through today how someone at 100K or at 200K benefits under this tax bill. And this is not weird provisions. This is automatically, you're going to benefit for this stuff. All right. Now, the first thing is this is the one big, beautiful bill here. You can see it on the screen. This is 389 pages. Okay. I've had to go through this thing. Now, the House Ways and Means Committee, you can go to my website at mattsorensen.com, has a summary of this bill, which is a little more digestible than reading the 389-page bill. I've gone back and forth between both. Now, House Ways and Means Committee, we can unshare things. The House Ways and Means Committee is where tax legislation comes up. So that's why it came through that committee. All right, so let's dive into the three main things. Then I'm going to run the two examples here, and I'm going to be doing the math as we go so you can see the calculations and the real numbers and dollars that we're talking about here. All right, the first thing that happened, rates. Okay, the rates are being adjusted for everyone except the bottom bracket, but that is only about 20 or 30K of income. But everybody is going to see their rate adjust. And on the lower brackets, you can see there, this is where we're going in 2026. If this tax reform doesn't pass, this is where we're going in 2026. The 12% bracket is the 15% bracket. The 22 is the 25. And at the highest range, the 37 becomes 39.6. So if this bill passes, it's looking promising, right? Republicans hold a majority. What we're going to see is everyone is going to see a tax break. The lowest 10% is only at very, very low incomes. Most middle income earners are at this 15, 25, and 28% brackets, okay? So the nice thing is everyone's going to see a rate reduction under this bill. Now, this is meaningful, okay? This 2 to 3% is very meaningful. This can be $2,000 to $3,000. Think if you have $100,000 of taxable income. So this is very meaningful having the rates go down. Now, there was talk Trump had about keeping a higher rate of 39.6 for those making $2.5 million or more. Sometimes he throws that stuff out as a negotiating chip, kind of saying, I'm willing to go to this if we have to. Now, in the current bill right now that's going through the House, that is not in there. There's going to be amendments flying. Who knows what's going to come in, what's going to happen on the House floor. Who knows what happens in the Senate. So we might see that. I don't see any of the rates adjusting except for that. That might be the one rate adjustment we see is 39.6 comes back, but only for those making $2.5 million or more. Okay, so right now, top rate, 37%. Now, keep in mind, this is being made permanent. These brackets are not another 10-year extension that are going to die, and we're going to all be struggling and worrying what's going to happen next year and taxes are going up. They're doing us a favor this time. They're making it permanent under this bill. So these rates will be made permanent. All right, now the next big thing that's happening is the standard deduction. Okay, now the standard deduction for 2026, what happened again 9 years ago is Congress passed a bill and said, hey, we want to double the standard deduction. Now, the standard deduction really benefits middle or lower income taxpayers because they don't itemize. Most higher income taxpayers itemize. They have mortgage interest, larger charitable contributions that go past the standard deduction amount. So they itemize on their tax return. So the standard deduction and doubling it really benefited middle income taxpayers. They don't have mortgage interest. They're not making large charitable contributions in excess of 20,000 or 15,000 where they exceed these standard deduction amounts. So this is very favorable to middle income, lower income taxpayers. Now, this is set to expire again. This is the last year of it. So in 2026, what's going to happen? Let's go to the rates here. If you're single, your standard deduction is being cut in half back to $8,300. If you're married filing joint, it's going to go to $16,600. If this bill passes, it is going to go to $16,300, essentially double. And if you're married filing joint, $32,600. This is massive. What this standard deduction does, if you make 100 grand, you get to take $16,300 off if you're single. So your only taxes if you made $84,000. And if you're married, you're taking $32K off of it. So your only taxes if you made, what is that? $68,000. Okay. So that's a huge swing where your taxable income goes down. It pushes you into a lower tax bracket. And of course, less income is being taxed. So having this standard deduction is critical to get passed. It really is one of the big benefits to middle income earners and working Americans. And, but it benefits everybody. Frankly, high, low income, if you take the standard deduction, you benefit under this provision. Now, this is again going to be made permanent in the bill. Another nice thing I like about this is going to be a permanent provision. That's how it's proposed right now. Who knows where this could swing? It might have a 10-year deadline. We don't know. But right now, what's gone through House Ways and Means Committee, the marked up bill that's going to the full House now is going to be made permanent on the standard deduction. So, and it also be indexed to inflation as well. So it'll go up over time as we have inflation. All right, so that's the second big benefit. All right, now the third benefit is the child tax credit. Now, what's happening with the child tax credit, and again, this applies to everyone that at least has kids, of course. So the child tax credit right now is $2,000. So you get a $2,000 credit. This is not a deduction. It's a credit against your taxable income. I'm going to do a calculation here so you see why that's so meaningful. But this is $2,000 right now. It is going to go down to $1,000 in 2026. But the provision right now for the child tax credit is, and what the old law is it's going to go to 1,000 in 2026 if nothing gets passed. It's still 2,000 this year, but it's going to go to 1,000 next year. That's the current law right now. What the provision is the child tax credit is going to go back to 2,000. Okay, this is going to get made permanent. But for the next 3 years, it's going to be, or should I say 4 years, it's going to be $2,500 starting in 2025, which means in 2025, your child tax credit will be $2,500, not $2,000. And next year, 2026, it'll be $2,500, not $1,000. All right. So the bill is really trying to address 2025, but it's also looking forward in the future as well and increasing that child tax credit, making sure it doesn't bounce back down to just $1,000. So a huge incentive there. And again, this is a credit off your income. All right. Now there's some other things in there. State and local tax deduction for those that itemize. All right. This is a huge one. This is right now the cap is 10,000. In the bill, this was raised to 30,000. There's a lot of politics on this. I've discussed this one a little more in detail in my prior videos. So get over to that if you itemize and you're in a state that has a lot of state and local tax. Right now, again, you can only deduct 10,000. But that's set to go to 30,000. They're raising the cap. A lot of politics in this one between states that have high income tax because this is a deduction off your state income. But let's go to the example. I just want to run through these three provisions here and talk about how this is going to save every individual that files a tax return. Okay, so let's go to the little whiteboard screen here. I know this looks like madness, okay? It's just like a beautiful mind, okay, like Russell Crowe. This is looks a little crazy, but I'm going to walk you through it. And this is really my notes to make sure I got the numbers right. I want to run the calculations. Okay, so I've got two scenarios on here, and this is assuming 2026. Okay, I'm doing an example in the future in 2026 to say if all this tax policy doesn't get passed, it looks bad in 2026 because we got higher rates, reduction of the child tax credit, standard deduction gets chopped in half. It's going to be bad. But if this bill does pass, I'm going to show you what it looks like. So I'm going to go back and forth between what the tax savings are. I'm also going to look at someone single at 100K with one child versus someone married with 200K of income with two children. All right. So let's go single first. All right. And hang with me on this. This is some math, but this is fun math because it's money going back in your pocket. Okay. So let's take someone with 100K of income. Now, the first thing we want to look into is the standard deduction. Okay. We got to take the deductions first before we apply the tax rate and then before we even apply tax credits. Okay. So 100K of income right now under current law for 2026, you're only going to get an 8,800 standard deduction, which means you're going to have taxable income of 91,200 versus if you're single under the new law, you'll get a standard deduction of 16,300, which means you'll have taxable income of 83,700. Okay. So that's the nice thing there is you're getting lower taxable income. Okay. That's coming right off the top at the very beginning. Okay. Now I'm going to go over to married here for a second. So the first principle here is lower taxable income. Okay. I got lower taxable income that will be subject to tax, even though I still made the same 100K. All right. Married, 200K. Now, what's going to happen is if this bill doesn't pass in 2026, that the standard deduction for a married filing joint is going to go to 16,600. If this bill passes, it goes to 34,000. Again, double the deduction value. What that means is you'll be taxed on 183,000 if this bill does not pass. But if it does pass under the current numbers we have right now, you will only be taxed on 166,000. Okay. So the first starting point is the deductions that you get to take as an individual, the standard deduction being the easiest one that every individual has the option of taking on their tax return. All right. Now we know what our taxable income is going to be. The next thing we got to know is our tax rate. Now, if we go back here to these images, remember the rate brackets here and where we're going to be sitting here, by the way, is right in the middle. We're going to be sitting right here between brackets and bracket 3, really, on both of these examples, where it's either you got a 25% rate if no bill passes, or you get a 22% rate if a bill passes. Okay, so kind of middle income, middle of the bracket as well here. This would be upper middle income, but all right, so let's break this down. Now, someone at 91,200, again, this is your taxable income if no bill passes. What happens is you're going to be at a 25% bracket and you pay that over $49,000. Okay. Basically, the way the brackets work is they say this is the amount of tax you owe. Anything over 49, you pay at a 25% rate. So what that means is we take this $5,578, which is your basement tax rate. This is adding up basically what you pay at the 10 and 12%, the lower brackets as you're adding up. And then they say, once you're over this amount, you make more than 49,000, you pay this 25% amount. This is for single filers. Okay. So what we've got here is 25%, and we're going to take it of 42,000 because it's what's over 49. I had to go with 91. Okay. Just trust me on the math there. Any of you accountants or anybody, you can double check it. But what happens here at the end of the day is I'm going to be paying tax of $16,000 if I'm filing single. Now, if you go over here to if the bill passes, the nice thing is our starting point is lower, 83,000. Okay. And I also get a 22% rate, not 25. So I'm already working at lower numbers here. Bottom line, what that means is your taxable your tax based on your rate and your income is going to be $13,000. Okay. I'm already saving $3,000 right there by having a lower standard deduction and by having a lower tax rate. Okay. Now let's bounce over here to 200K. Same analysis. All right. So we have our starting point of our taxable income here. But again, we got the same rate issue. It's either 25% or 22%. That range of income, that bracket's pretty wide here. And for married, it's about the same as single. You got to double up the income for the married brackets. That's why you might be like, well, 200,000, aren't they at a higher rate? No, because I got married. Okay, married gets, you have more. There's assuming two people earning income, so you jump up here. You can have 200K and still be in this 25 or 22% bracket. Okay. So under the current law, if this does not pass, what this means is you're going to be paying at 25% on a higher income rate. And what that means basically is you're going to be paying $33,000. But if I've got less taxable income, because I got a bigger standard deduction, a lower tax rate, it computes out to lower tax owed of $26,000. So right there, if I'm married filing joint, I'm saving $7,000 here. I'm not even getting to the child tax credit yet. Okay. That's a huge amount of money, right? I'd rather send the IRS 26 than 33,000. Okay. That could be your refund coming back. And again, this stuff's going into effect in 2025. What's going to happen to a lot of people? They're going to be seeing refunds because they've been paying. And sorry, this is 2026. Sorry. So for 2026, what's going to happen is a lot of people are going to be certainly paying less tax. We're going to see more refunds, less tax owed in the future, putting more money in people's pockets, spending the economy. I think it's going to have a lot of great benefits. All right. Now we're not done yet. Okay. We're not done yet. All right. Let's look at the next layer that we have here of the child tax credit. So remember on single here, and let's unshare the screen for a second because I got that's a lot of math there. Okay. Remember on single. Okay. Right now, the child tax credit is $2,000. Okay. It's going to bump up to $2,500. That's for 2025 and moving forward. But I'm looking at this analysis for 2026 for the example here, just so we can see the impact of this bill as we're moving forward. It's going to be $1,000 child tax credit. Now it's going to be $2,500 for the next 4 years. And then it's going to go back down to 2,000. Again, it adjusts for inflation here. But what'll happen here is, let's go to 2026. Let's share the screen back because I just want to illustrate the example. Okay, so remember we got someone over here, no law passes, single, making 100K because their standard deduction got cut. And because they're at a higher rate, they had to pay $16,000. Well, they're going to get the $1,000 child tax credit in 2026, which means they'll pay $15,000. Okay. However, take that same single person making 100K a year with one child, they get a lower starting point because they got the standard deduction doubled. They had a lower rate. So they were only going to owe $13,000, but they got one kid. This is a tax credit. This is not a deduction. So we get a tax credit of $2,500, which means they're only going to be paying $10,558. In other words, someone making 100K with one kid, just taking the standard deduction and the rate, their effective tax they're only paying is 10% on 100K, right? They only paid $10,500 or 10.5%. I mean, this is saving right here. The savings under the bill here, single, one child making 100K a year is $5K. Okay, pretty significant amount of money. That's 5% back in their pocket of what they make instead of going to the IRS. All right, now let's look at over here on the married side. It's even more significant because we assume two kids over here. All right, so we assumed under the current law in 2026, half of a standard deduction, a higher rate, they were going to have to pay $33,000. Now they have two kids in the example. So in 2026, they'll get $2,000 deductions. So they're going to pay $31,000 in federal tax. But if we bounce over under the bill, if this passes, they have a lower starting point. All right. Because they've got the lower rate. They got a bigger standard deduction. They've already saved $7K here alone. So they were going to owe $26,000 in tax. And if you have no kids, just stop here. This is your tax savings if you had no kids. Married filing joint. Okay. Now, if you got kids, we're going down to this next level. Two kids, that means your tax saving is going to be $5,000, meaning I'm only going to pay $21,000. Okay. Again, here, this is basically 10% total effective tax rate of what you're going to have. Married filing joint making $200K a year versus over here paying $31,000, which is almost like a 15% total tax that you're going to owe. This tax savings here, $10,000, is huge. $10,000 is going to go back into the pockets of those making 200K, married filing joint with 2 kids. If you didn't have the kids, you would have been at 7K of tax savings. So huge tax savings and benefits. And I think it's, actually, yeah, I got the numbers right. Okay. So huge tax savings and benefits for someone 100K and 200K. Now, if you're in a higher rate, you're making 500K a year, you're going to be saying a similar level of taxes here where you might be saving about 5% in total tax of what you'd otherwise pay based on your income level. So if you're making 500K, you might be saving $25,000 in tax, okay? Because the way they've worked this in the brackets, and you can see from some of these numbers as I'm getting down to it, there's about a 5% tax savings based on their income. Now, that's not universal here. I'm just roughing it out, some cowboy math for you. So, but everyone's saving under this bill, all right? And the value of these tax credits is significant for any of you that have children. Again, going up to $2,500 per kid. All right, now I want to hit some other things that you should know for if you're a business owner. Just 2 quick things. I got some other videos on this. Make sure you're subscribed to my channel, okay? I've got a lot of other content on just how to save taxes in general, protect your assets, grow and build wealth. That's what my channel's all about. But one of the biggest expenses we have as individuals trying to build wealth, or as business owners or investors, is taxes, okay? It's our largest expense. And so knowing how to navigate that is critical. So make sure you're working with a good CPA or a tax lawyer. My law firm, KKOS Lawyers, we advise individuals, small business owners, investors across the country. So you can get to KKOSlawyers.com, book a comprehensive tax consult with one of our attorneys, and we'd be happy to help look and see what makes sense for you. And don't feel like you got to be making millions of dollars a year to work with a tax lawyer. We work with the clients making 100, 200K all the time. All right. And good tax savings can be a couple $1,000s every year that you get from getting the right strategy in place. But we also want to know where the puck is going here. All right. Okay. That's a Wayne Gretzky quote, the great one. Like, we want to know where tax policy is going. So we want to know how to plan for the future as well. All right. For business owners, just a couple of quick notes here. 2 big things for business owners. If you're a small business owner, 199A. This is bonus depreciation, will be back in 2025. It goes until 2029 under the bill. It might be made permanent. Who knows? It might have a different sunset. It might phase down. But right now, what came out of the marked up bill going to the full house is 100% bonus depreciation for 2025 through 2029. We're going to see how this, if it changes, I'll be tracking this, but that's huge. That means if you bought an equipment, you bought an auto in your business, a vehicle that qualifies, let's say it was $50,000, you take the $50,000 deduction. All right. You take the whole thing right now. What's going to happen in 2026 is you only get 20%. So if I bought a $50,000 piece of equipment or a qualifying vehicle, I only get to take $10,000 as an expense. I don't get to expense the whole thing. I got to take the rest over time. Well, I'd rather expense the thing right now, get the savings on my taxes right now. So that's a huge one. Bonus depreciation is back. The second one is qualified small business deduction. Again, I got other videos on this going more into detail on this, but that's QSBS. This was set to expire again this year. This is one of the provisions that's going away, but it is being not only renewed, but being made permanent. Okay, that's a huge win for small business owners. It will be made permanent, and it is going up from a 20% deduction to 23%. What that means is you make 200K in your small business. You get to take a 23% deduction on that. That's $46,000. You're only going to be taxed now as you've made $154,000. If that bill doesn't pass or that provision doesn't make it through, you're going back to being taxed on 200K. Huge tax hike coming for small business owners if this provision doesn't pass. Now, not only is this one going to get extended, it is permanent in the bill right now as it's going. So get over my other videos. I've got other stuff coming out on tax breaks and other incentives for small business owners. There's a few more that are important as well. But I want to focus on the individuals right now, give you some real examples on how these adjustments to the tax rates, how the standard deduction, and how the child tax credit, just 3 things that everyday Americans rely on their tax return, can help you. Now, I'll be back, so make sure you're subscribed. I'll be going live as there's any updates on this. I'll be providing more content. There's cool things on HSAs in there. I'm going to be talking about the MAGA accounts and how those work. This is a brand new concept that's out as well. So I'll be giving you tips on those and how you can incorporate those into your wealth building strategies. I'm Matt Sorensen. We'll see you next time.